The Uptick rule is a trading regulation designed to limit short selling during periods of rapid market decline. To understand the rule, we first look at short selling, where an investor bets that a stock price will go down. The modern rule triggers specifically when a stock has fallen by 10% or more from the previous day's closing price. Once active, short sellers are restricted from driving the price down further. They can only sell short at a price above the current best bid. The original rule was broad, but the version used today is more targeted, focusing only on stocks experiencing significant volatility. By limiting the ease of shorting during a crash, regulators hope to curb panic selling and provide a bit of market stability. Think of this regulation as a circuit breaker. It does not stop short selling, but it makes it harder to aggressively push prices lower. Thanks for watching. Understanding market mechanics helps you navigate volatility with more confidence. Please subscribe for more finance basics.